Are you running a real business, generating consistent revenue, paying your bills, growing month after month, and still got denied for a loan? Does it feel like lenders are seeing something completely different from what you see in your business? The reality is that over 80% of small business loan applications are denied by banks. Many good small businesses keep getting rejected. So what's really going on? You will soon learn the real reasons lenders say no again and again. Jake owns a mid-sized landscaping and light construction business. He started it about 4 years ago. He's built something solid and business is good. Jake is booked out 6 weeks in advance. He's got a small crew and a couple trucks on the road. Most of his work now comes from repeat clients, property managers, small commercial contracts, higher-end residential jobs. Average project size is growing. Margins are solid, and this season is shaping up to be his biggest yet. Last month, the business brought in just over $92,000. This month will likely be similar. On paper, things look strong. But there's a problem. Jake turns down work almost every week. He's already fully booked, and new jobs keep coming in. But he just doesn't have enough trucks or crew to take on more jobs. To fix that, he would need another truck, some more equipment, 2 additional crew members. He's done the math, and it comes to about $60,000. With that expansion, revenue could push past $120,000 a month within a few months. Without it, growth stalls, keeping him stuck at a $90,000 per month ceiling. And every week that passes, more work has to be turned away, more revenue stays unrealized, and more opportunity slips by. So Jake applies for funding. He's not asking for a lot, just $60,000, enough to expand before the busy season hits. He fills out the application, provides revenue figures, uploads bank statements, submits everything they ask for. Then he waits. A few days later, the response comes back. Denied. No real explanation, just a no. So Jake applies again. Another lender, same business info. Denied. He tries a third time. Different lender, same result. Jake can't understand what's going on. Why is this happening? Meanwhile, the calls keep coming in. Jobs he could take if he just had the capacity. But he doesn't, because he still doesn't have the money to expand. So the business keeps performing but not moving forward. And the longer this continues, the more growth stays delayed, while the business keeps operating below its full potential. Plus, the busy season is getting closer. Jake doesn't give up. He keeps trying to get funding. Late at night is when he finally has time to search for more lenders. He tries different ones, banks, credit unions, even various online lenders. Same answer every time, again and again, no. Jake looks at his numbers again. Revenue is there. Demand is there. The business is profitable. So he's left wondering, how does a business like this keep getting denied? What are these lenders even looking for? To him, the logic is simple. The business is strong, so it should qualify for funding. But that assumption is exactly where many good businesses unknowingly go wrong. Jake is looking at his business through the eyes of an owner. He sees it as a whole, his revenue, his customers, his growth. But lenders don't see his business that way. They are looking at it through the lens of risk. Lenders use a very specific system to evaluate a business. That system is called a model, and each lender uses one. The model takes the information about your business and answers a single question. How likely is this business to repay us? That's it. It's similar to a doctor assessing your health. They don't need to know everything about who you are or what you hope to do in life. They just need to check your vitals, specific indicators like your blood pressure, heart rate, weight, age, and medical history. Then they can draw a conclusion. The lender's model works in much the same way. It's not asking, Is this a good business? Does it have potential? Is the owner hardworking? It only wants to know, how likely is this business to repay us? To answer that question, the model looks at specific signals, and based on those signals, it reaches a conclusion that isn't just yes or no. That answer exists on a scale from highly likely to repay down through unclear to highly unlikely to repay. Businesses that are more likely to repay are seen as lower risk. Businesses that are less likely to repay are seen as higher risk. And from that, a decision is made. A clear approval, a denial, or something in between. Now, once you understand this fact, we can answer the real question. What does it mean to be denied by a lender? Most business owners completely misunderstand what a denial means. Here's the truth. A denial does not mean the business is bad or unworthy. It does not mean the business has no potential or future. And it does not mean the owners are incompetent or failures. A denial simply means this: the business did not match what the lender's model was looking for. That's it. That's all. And this is what most business owners get wrong. They believe that they and their business are being judged, but this is just not true. Instead, they are just being measured against a model. And the reality is that good businesses don't get denied because they're weak. They get denied because they don't match the lender's model. And that mismatch can happen in very specific ways. Ways that have nothing to do with how well the business is actually performing and everything to do with how it's being interpreted. I'm Dale, a fellow business owner and entrepreneur, as well as a former high school and university educator. Over the past few years, while working with business owners looking for funding, I saw many good businesses getting denied by all types of lenders. That led me to do a deep dive into why this was happening and what could turn things around for those businesses. Today, I'm going to show you how a business that is profitable, growing, or well-run can still be seen by a lender as high risk. To understand this, we will examine 4 common reasons good businesses still get denied. The denial reason most business owners don't even know about is this. Reason number 1, automation filters. Most business owners assume that when they apply for funding, someone looks at their business, their revenue, their growth, their potential, and their story, and then a decision gets made. But in many cases, that never happens. Because before an application ever reaches a human, it goes through a set of automated filters. It's like being stopped at the gate of a secure building. If you fail that initial checkpoint, you are denied entry, and you don't reach the people inside. In a similar way, the automated filters act as the first gate in a lender's system, and their job is simple: to quickly screen out applications that don't meet certain minimum criteria. Most criteria are based on core factors like personal credit score, time in business, monthly revenue, existing debt, and in many cases even more detailed things like bank account activity, how often it goes negative, or whether payments bounce. Some systems even count how many deposits come in each month and compare that against their criteria. But what many small business owners don't realize is that before any of those core factors are even considered, the system checks on the legitimacy of the business itself, how it's set up, where it's located, whether the business details match everywhere they appear, and even how the business presents itself, right down to the email address it uses. Is it a personal email address or one tied to the business domain? And if the business doesn't meet the lender's thresholds, the application stops right there. No context, no explanation, no deeper review. That application never reaches a human. An automated decision is made, application denied. This isn't rare or unusual. automated denials are much more common than many business owners realize. Most lenders today use some form of automated pre-screening or auto-decisioning software to handle the volume of applications they receive because it's faster, more consistent, and easier to scale. But here's where the misunderstanding happens. Jake assumes his business was evaluated and rejected, but in reality it may have not even gotten to the evaluation stage. It may have simply failed the lender's first checkpoint, that initial filtering process. Not because the business is weak, but because it didn't match some specific minimum requirements built into that lender's model. So while Jake believes a lender looked at his application and said no, it's more likely that his application never made it far enough to even be considered. The reality is, funding applications often get denied before a lender ever sees them. Once you understand this, you start to realize something important. A denial doesn't necessarily mean a lender looked at your business and rejected it. Sometimes it just means you didn't pass that first gate. Even though many business owners don't know this, good businesses can be denied funding without any human involvement. The most misunderstood reason good businesses get denied is reason number 2, signal mismatch. Jake has already applied multiple times trying to get some money to expand his business. Different lenders, different applications, same information submitted, and the answer keeps coming back, no. Since different lenders each have their own model, it's very likely that only some of those denials were automated and other denials happened at some point during the human review process. Jake assumes that if someone is looking at his business, they should see what he sees. Revenue coming in every month, a full pipeline of work, repeat customers, growing demand. In his mind, those signals are strong. They are signs of a good business, and a good business should mean low risk. But here's where the disconnect happens. The signal Jake believes matters most are not the same signals that lenders rely on. Think about an X-ray for a moment. Does an X-ray image show everything like a photo would? No, it only shows the specific internal structures that the X-ray machine is designed to show. A lender's model works in much the same way. It doesn't capture a picture of the business as a whole. It's designed to reveal specific types of signals. Signals it knows how to interpret. Signals it can measure. Signals it can trust. For example, it's true that Jake has strong revenue, but he doesn't have an established business credit profile. There's no real history of the business borrowing and repaying. No clear track record the system can reference. You see, Jake never bothered with building business credit. It didn't seem that important to him. And he never needed to borrow before now. His business makes good money, and he feels that should be enough to get approved. But that's not how the lending system sees it. There's no direct evidence of how this business handles credit. Nothing to show if this business can be trusted with a loan. And without that, the system cannot confidently predict its repayment behavior. So instead of seeing a strong business, it sees an incomplete picture. And in the lending world, incomplete data is often treated as higher risk. There's something else the system sees. Jake's revenue is solid overall, but it's not always consistent. Some months are much higher than average, others are much lower. That's normal in his line of work, but to the system, inconsistent patterns are harder to rely on. And when something is harder to rely on, it gets treated as higher risk. And when the risk is too high, lenders deny. So they say no, not to a weak business, but to a business that doesn't match the signals the model is designed to understand and trust. Jake thinks his business is being evaluated based on how well it's performing, but the system is evaluating it based on how clearly it can measure and predict risk. Those are not the same thing. As far as Jake is concerned, he applied, the lender looked at his business, saw a good business, and still said no. But to the lending system, the signals it relies on to say yes were either missing, unclear, or inconsistent. And when that happens, the outcome is often the same: denied. Once you understand this, you start to see a very different pattern. A business can be doing well and still be seen as high risk, not because it's actually high risk, but because it doesn't match the signals the system is built to trust. Many small business owners don't realize that good businesses can be denied as a result of mismatched signals. The next reason good businesses get denied is actually the one that is the easiest to fix. Reason number 3, structural issues. Jake is trying to make sense of what's been happening. He knows his business is doing well, but he keeps getting denied. So now he starts wondering, what exactly are they seeing that I'm not? Everything looks fine to him, but what Jake doesn't realize is this. Sometimes the issue isn't the business itself, it's how money moves through the business and how the business shows up in what the lender sees. For example, when Jake started his business, he didn't open a dedicated business bank account. He used his personal account for accepting client payments, and things stayed that way for a few years. Many small business owners are like Jake. They never open a dedicated business account. They don't see the value in doing that. Instead, they just use their personal account for all transactions. In their mind, at the end of the day, money is being made and bills are being paid. But not having a dedicated business account might seem trivial. To the lending system, there's no clear separation between the business and everything else in the business owner's life. So it becomes harder to isolate what the business is actually doing. And when something is harder for the system to see clearly, it becomes harder to trust. And that increases risk. And remember, when the risk is too high, lenders deny. Jake eventually opened a business bank account about 4 months ago, but things are still a bit messy. His clients pay him in different ways. Some of his regular clients are still making payments to his personal account. Some payments go straight into his business account. Others come through his personal Zelle, Venmo, or Cash App accounts. He hasn't set up the business versions of them yet. Some other payments are made in cash or check and get deposited later, often combined into a single deposit. Even though payments are coming in each week, Jake doesn't always have the time to move external payments into his business account right away. Sometimes days go by before he's able to move payments or to deposit cash and checks. So what shows up in his business bank account doesn't always reflect when the payments were received, who they were from, or what they were for. This is particularly common with cash payments. When he deposits them, they usually just show up as cash deposit. It's still all just income to Jake, but to the lending system, it's like driving with a foggy windshield. The road may still be there, but when visibility becomes unclear, it becomes harder to move forward with confidence. In Jake's case, the timing of payments isn't always consistent, and the source of the money isn't always clear. So instead of seeing steady, traceable income, the system sees gaps. And when revenue is harder to verify, the business gets pushed further down the repayment likelihood scale, into the unclear range or even towards unlikely to repay. And when that happens, the outcome is usually the same: application denied. Another easy to fix structural issue has to do with how Jake spends his money. He hasn't yet gotten in the habit of separating personal and business finances. Some of his business expenses are still going through his personal account, and from time to time he uses the business account to pay for personal expenses. The result is that business activity and personal activity are mixed together, and that makes it harder for the system to clearly understand what the business actually costs to run, which again makes the picture less reliable. Also, sometimes Jake uses the cash he receives to make payments to his suppliers, cover other business expenses, or pay himself. He doesn't realize how this affects what the system sees. When Jake looks at the money coming in each month, he sees about $90,000. Every month, about $20,000 of that is being used as cash and never gets deposited. When the lending system looks at his business bank account, it doesn't see a $90,000 per month business. It sees a $70,000 per month one. His annual revenue shows up as $840,000 instead of $1,080,000. So his business looks smaller than it actually is. A lender cannot make a decision based on numbers it can't verify. And if it can't verify, it's almost certain to deny. Now, the last easy-to-fix structural issue we'll look at is how the business shows up in the data. Jake operates under a business name, and he does have an EIN, but financially, most of the activity is still tied to him personally. There isn't a clear, consistent separation between him and the business in the data the system sees. So when he fills out a funding application, even if he includes his EIN, the rest of the data doesn't fully support it. When the system evaluates his application, it doesn't just look at what's written on the form. It looks at the data behind it. And in that data, the business identity isn't clearly established. So the system doesn't just see a business, it sees a person with some business activity attached. And that changes how risk is interpreted. When all of this comes together, it doesn't look like a clean, stable business profile. Instead, the system sees something that's not clear-cut, something that's harder to define, harder to measure, and harder to predict. And when something is harder to predict, it gets treated as higher risk. Again, remember, when the risk is too high, lenders deny. Denials based on these structural issues are most common with lenders who offer better funding options with better rates and terms. Those lenders only want businesses that they can clearly see as low risk and very likely or highly likely to repay. So once again, it's not about how good the business is. It is about how the business appears inside the lending system. Jake is looking at performance, but the system is looking at structure. And those are not the same thing. Once you understand this, you start to see how small set of details can quietly change how a business is judged, even when the business itself is doing just fine. As we've seen, these structural issues causing a good business to get denied are usually the easiest to fix to turn things around. Now let's look at the denial reason that feels most unfair to good businesses. Reason number 4, industry risk. Like most small business owners, Jake believes that a lender's decision is based solely on data about him and his business, his personal credit score, his time in business, his monthly revenue, his growth. But that's not how things work. The lending system doesn't only look at the business itself, it also looks at the type of business it is and the industry it belongs to. This is similar to car insurance. You may have a flawless driving record, no tickets, no accidents. But if you insure a sports car, your premiums will likely jump. Why? Because the insurer isn't only looking at you, it's also looking at the kind of risk that vehicle, your sports car, usually brings. Sports cars are built for speed. They cost more to repair, they get into more accidents, and are highly targeted by thieves. As a result, their baseline insurance premium starts at a higher level. Securing capital for your business works in a similar way. Inside a lender's model, every industry is assigned a level of risk, not based on any particular business, but based on patterns, based on what typically happens across thousands of similar businesses within that industry. How often they fail, how stable their cash flow tends to be, how predictable their revenue is, how sensitive they are to outside factors. And based on those patterns, some industries are seen as lower risk, some are avoided completely, and others are simply treated as higher risk. This last group includes industries where revenue fluctuates because of seasonal work or project-based jobs, industries where there's little room for error because margins are thin or unpredictable, industries where failure rates are higher due to competition, rising costs, or market volatility. For businesses in these restricted industries, the system's answer to how likely is this business to repay often falls on the lower end of the scale. Lenders often apply stricter criteria to businesses in restricted industries, requiring longer time in business, higher minimum monthly revenue, more support and documentation. So even before Jake's business is looked at on its own, it's already being viewed through the lens of the industry it belongs to. And that matters more than most business owners realize. While Jake is looking at his business as an individual case, the lending system is looking at it as part of a larger group, a group that already has a risk profile attached to it. So even if Jake's business is doing well and his numbers are strong, they don't speak for themselves. They are interpreted through the lens of his industry, and that lens changes how those numbers are understood. To see how this works, consider two businesses, both generating about $90,000 a month in revenue, both in business for just over 3 years, both with owners having strong personal credit scores over 720, and both applying to the same lender for $150,000 in funding to expand. Business A operates in a lower risk industry. It hears back within 24 hours. It's been approved for the full $150,000 at a 9% annual rate over a 5-year term with standard monthly repayment options. Business B is in a restricted industry. After submitting the initial application, it received a request for some additional documentation, which it provided. A few days later, it finally hears back, approved for just $80,000 at a 22% annual rate over a 2-year term with tighter repayment conditions. Two businesses, same numbers, same lender, but very different lending experiences and dramatically different outcomes. Not because one business is better, but because one industry is seen as more predictable, more likely to repay than the other. Through no fault of its own, Business B is starting off at a disadvantage. And this is where it starts to feel like the system isn't being fair. But there's another layer to industry risk that most business owners don't know. Each lender also manages its own exposure to different industries, meaning they don't just decide whether a business is risky or not, they also decide how much of that type of risk they're willing to take on, how many businesses in that industry they are prepared to lend to. Think about your local supermarket. It may carry products across many categories, but it still decides how much shelf space to give each one. Some categories get more, some get less, and some products may not be stocked at all. Lenders do something similar with industries. Some avoid certain industries completely, others only allow limited room for industries they see as riskier. So even if Jake's business meets all their criteria, a particular lender might still say no because they already have too many loans in that industry, too much exposure to that type of business. The lender is simply trying to manage its overall risk, and Jake gets a no without any clear explanation. Denials driven by industry risk often feel like the most unfair reason lenders say no to otherwise good businesses, because it's based on things completely outside of their control. Jake isn't just being evaluated on his business and its numbers, he's being evaluated based on his industry, its history, its patterns, and the lender's own limits. And when that combination pushes the perceived risk too high, guess what happens? That's right, lenders deny. Yes, Jake has a good business, solid revenue, repeat customers, growing demand. And yet, when he applied for funding to multiple lenders, each time the response was the same, denied. That left Jake confused and frustrated. He couldn't understand how a good business like his could keep getting denied. It felt random, unfair, even personal. But now you can see what Jake couldn't see. Those denials were not random, and they weren't based on whether his business was good or bad. They were the result of how his business was being seen, interpreted, and evaluated inside the lending system. Sometimes his application never made it past the lender's automated filters. Other times, the signals his business was sending didn't match what the system was looking for. Sometimes the way his business was structured made the data harder to trust. And sometimes it was the industry itself and the lender's own limits that worked against him. Any one of these, or a combination of them, could have led to those denials. Once you understand this, you stop asking, why did they say no? And you start asking, what did the system read as too risky? Now, here's the part that matters most. You can only control what you can control. The state of the economy, market volatility, how the lending system works, these are outside of a business owner's control. But there is still a lot within their control. Jake cannot change the industry his business is in. He can't control how lenders manage their exposure or how they classify risk across different industries. But the other three reasons lenders say no to good businesses, those are within his control. Jake can make sure his business meets the minimum criteria before it ever hits an automated filter. He can strengthen the signals his business sends so they align with what the system knows how to interpret and trust. He can clean up the structure of how money moves through his business so the data becomes clear, consistent, and reliable. And when he does that, something important starts to shift. The same business starts to look different to the lending system. Risk starts to come down, confidence starts to go up, and the answers he gets start to change. Stronger funding starts becoming possible, better rates, better terms, and new opportunities to grow. Work that had to be turned away can become possible again. Expansion that felt blocked can begin to move forward. Because in the end, it's not just about how good the business is, it's about how clearly the system can see it, how confidently it can evaluate it, and how likely it believes that business is to repay. If your business is strong, the goal isn't to make it stronger, the goal is to make that strength visible, structured, and aligned with how lenders actually evaluate risk. Because once alignment happens, the same business that was denied can be seen completely differently and experience a better outcome. Strength becomes visible, risk becomes clearer, and opportunity stops getting blocked by avoidable risk signals. If your business is being denied, it's not necessarily because it's weak, it's because it's being interpreted a certain way. And once you understand that, you're no longer stuck guessing, you're starting to see the system clearly. Now you know the real reasons lenders say no to good small businesses again and again. And this is where your power resides. You have the power to align your business with the signals lenders trust, to remove the hidden issues that trigger unnecessary denials, to present your business in a way the system can clearly evaluate, to lower your perceived risk in the eyes of lenders, to qualify for strong yeses, better funding with better rates and terms. You just need to know how. And that's exactly what I'll show you in our free training. Click the video on screen now or the link below to take control of how the lending system sees your business. See you on the other side.